The case again is this our Whistler hotel. So you are the financial consultant for this company. You are expected to scrutinize and make a dissection of the hotel financial situation. So you have to explain what's the current financial situation and provide some insights that will support strategy growth, bolster shareholders' value, and all while ensuring the integrity of the financial practices. So let's see what we have. Jude Peter, that's the former national level ice hockey player from Abbotsford, British Columbia, underwent a significant cancer career changes due to the career-ending injury. His father innovation to manage a boutique hotel in Whistler led him to create this thing, a unique hotel concept, blending with these principles with the vibrancy and ski resort. Jude's vision is to include the holistic wellness retreats. That's his vision. The cuisine and yoga and meditation workshop, all with the early bird and bundle pricing deals. So we're providing all this. We're providing holistic wellness retreat. We providing cuisine. We're providing yoga. We're providing meditation workshop. Everything is on the early birds. So basically, we're chasing people who are before the season, getting purchased ahead of time, and we're chasing bottom pricing deals. So we're combining many things, yoga, meditation, and cuisine, and we're selling it as a packages. Peter's venture has been a collaborative effort from the start, with many of the shareholders being close friends who believe in his vision. His promise to them was simple. As the company increases, so the dividend will increase as well. This commitment to increase their dividends has been important for his approach to business, reflecting both his graduate for their support and his desire to see them benefit directly from the company's success. However, company recent financial performance increased there's a problem now with the accounting team. The accountant, looking strictly at the numbers, advise against increase of dividend under the current financial conditions. So basically, the accountant says, please don't pay the shareholders dividend. The concern is clear. The company have to preserve the cash, or the company, the cash going down, liability is going up. So we have a potential problem, financial problem. This conservative viewpoint is to safeguard the company financial stability, which conflict with the initial promise to the shareholders. So you understand what's happening now. The shareholder holds the dividend. The accountant says, don't pay the dividend, don't increase the dividend, because our liability going up, the cash going down. So in order to preserve the company, we have to slow down on the dividend, which is against what the shareholders want and which is against what the Peter was initially promised the shareholders. Now, Jude is having problem with the tough decision. What he should do? to honor his original promise to increase the dividend, which we're gonna maintain the trust and the goodwill to shareholders. But if he do that, then there will be a financial problem in the company.
Yeah.
Or the other thing is, first one is that he has to choose what to do. Increase the dividend so he can keep the promise, he can keep the shareholders happy, but create a financial problem in the company. The other option is, should he consider the accounting advice to delay on the dividend hike, which can help the company to preserve the financial health, but might also lead to disappointment among the friends and investors. The path Jude chooses will not only review his business ideas, but also test the strength of his professional relationship with those who are invested, not just in money, but their faith in him. You understand what he has to decide, correct? He has to decide on two things.
Yes, sir.
One option is keep giving, increase the dividend, keep them happy, make your promises, look good in their eyes, but put the company in financial trouble. Option one. Second option, explain to them that you have currently financial problems, follow the accountant advice, delay on the dividend, and explain the people that, hey, such things happening, but they might be disappointed.
Mhm.
Over the past year, company has faced declined cash reserves, creating anxiety about liquidity and ability to cover the short-term liabilities. So which ratios are affected here? Current ratio and liquidity and quick ratio. Make sense? Why is the current ratio? Current ratio is the direct proportion between the current assets and current liabilities. Financial statement extract expose key movement of the company financial position. Let's see what's happening here in the financials. Cash reduced from 50 to 20,000. Short-term investments go from 20 to 25. Accounts receivables grow from 100 to 120. Prepaid expenses from 40 to 55. Total current assets increase with 10,000. Accounts payable change from 80 to 100. Accrue expenses increase from 40 to 50, and the total current liability went from 90 to 30. So the first thing that you can get, current assets versus current liability ratio. So the current ratio, as you can see, 210 versus 190, to 220 to 230. In the beginning, right? In the beginning of the period, we can cover our current liabilities with our current assets. Now we cannot. Make sense? Can you see it? Okay. Please find below the extract from the minutes from the most recent meeting. So let's see what's the meeting. Trainee accountant, Jude, after reviewing the financial, there has been upstick of the revenue so the revenue going to 550, yet our liquidity was weakened, and notably our net income has dipped to this one from last year. So the net income, the revenue go, but the income goes down. Are all income sources included in this? And how much has our current ratio fallen? Can we calculate the current ratio? Can you calculate the current ratio? Yes, you can. So yes, all income sources are considered. The search of the operating expenses, the increase of is the main reason from our financial punch. This is also lead to the year profit decrease. So what's the problem with the net income? Because we have operating expenses increase with $310,000. This is the drastic turn from profit to a lower profit margin is worrying. We must look closer our growth strategy and financial control. Could we have missed something in our accountants? Rest assured, the analysis is accurate. The loss is mainly due to the higher operating cost, especially from upgrading our spa facility, including impacting our earnings. It's a challenging time. Our investment in wellness experience was substantial. We need to reevaluate our strategies to ensure financial stability while still aiming for a long-term goal. We might have overextended financially. So let's see what is happening. The extract for the income statement is follow. Expenses. Expenses on the utility expense goes up. Wages goes up. Maintenance repair goes up. Marketing advertising goes up. Insurance goes up. Food beverage cost goes up. Technology upgrade goes up. Training development goes up. Laundry lines, property taxes obviously goes up, and total expenses we can see from 220 went to 310. Let's see the revenue. The revenues, the way we see, okay, the room sells 330, all the revenue goes up, correct? We're selling more. We have the volume. We haven't changed the rates, though. Can you see? The rate stays the same. We haven't changed the rates. We only increase the volume. The increase in volume gives us that increase in revenue.
Okay.
Now, the increase in revenue, as you can see, is very minor, where the increase in the expenses went up with pretty much 50%. Because we have increases at 90,000, which is 90,000 is more than 40% definitely compared to the last year. So under the stewardship of his managing director, Peter is seeking your professional expertise as a financial consultant to critically assess company liquidity position. This company increasing pressure from the shareholders for the rise of the dividend payout. You're charged with reviewing the current liquidity ratio, providing insights, and formatting strategic recommendation based on the provided financial data. When necessary, you're encouraged to make a valid assumption of the to underpin your analysis. Okay, so basically what we're chasing here, the key here is the liquidity position, correct? Can you see it?
Yes, liquidity position.
So from where we're going to get that liquidity position? Let's think about it. From the ratio analysis, correct?
Yes.
Yes, Professor.
Which are the ratios related to liquidity?
Current ratio and quick ratio.
Okay, so what we have to
Current.
do, so hold on a second before we do that, what we have to do. I'm going to share my screen, just a second. Once we go to the financial statement analysis, we're gonna go to the ratio analysis, and we're gonna check the liquidity ratios. Which are the liquidity ratios? Current ratio and quick ratio. Do you know how to calculate them?
Yes.
Yes, we can,
Yes, Professor.
right? Once you calculate this one, can you comment on this?
Yes, Professor.
Yes. Okay. Do we have to worry about activity ratio? No, activity ratio is not our problem. We don't dealing with that one. What else we can think about it? What's the other ratio that possibly we can discuss? Solvency, we don't have information about debt and equity, so we cannot comment on that one. We don't know the income before before interest, taxes, depreciation, expense, so we cannot comment on that one.
Profitability.
We can comment on the profitability eventually, right? That's the only thing
Yes,
that we can
Professor.
comment. Profit margin, nothing else. So what I expect from you is here, in order to get this, I want you to do two things. Let's go back to the case. And I'll tell you what is expected from you. What I would expect from you to get this part correct. Before I do that, just a second, just give me a sec. I want to do something else. I want to take a snapshot of who is here today. Since I have so many students, I have 38 students at this point. Let me take this picture just in case. Okay, done with this. And let's go back to the case. Can you guys see my screen?
Yes, Professor.
So what I expect from you too, I want you to quickly analyze the situation of the company. So what you can say is, talk a little bit about the increase in the cost versus increase in the revenue, right? So what I expect first is situation of the company. Increase current situation, that will be increase in costs and revenue. So I want you to come up with naturally with the idea that the cost increasing more than the revenue. Okay, that was the first way. Second, liquidity. Talk about the current ratio. I expect discussion on the current ratio. Do you have enough information to calculate the current ratio? Tell me.
Yes. Yes,
Yes.
Professor.
Okay. Once you calculate the current ratio, can you comment on the quick ratio? On the quick ratio, remember, I have to eliminate inventory and prepaid expenses. Can you do that?
Yes.
Yes. So number 3 that I expect from you is, again, liquidity. Quick ratio. Once you finish with the liquidity ratio and quick ratio, comment a little bit on the profitability. On the profitability, you can easily, you have the net income, you can get the net income, and you get the revenue, correct? You can comment on the profitability. So net income, revenue versus net income versus revenue. And once you do that, I want you to provide, discuss the two options. What are the two options that you have? One is to increase the dividend, keep your word, make the shareholders happy. Second option is not give them dividend, preserve the cash, explain the situation, tell again the two options, and recommend one of them based on this analysis. Correct? Do you understand what I do?
Yes, Professor.
So outline the options, the two options, and then the sixth one will be recommend one option. So the key here is whatever you recommend, as long as you can justify it, it's going to be correct. You can say increase the dividend. But if you go increase the dividend, then I expect you to tell me, sell the short-term investment, improve the accounts receivables, and that's going to improve your cash. Because if I get rid of the short-term investment, that's 25,000 coming to my cash, correct? If I straighten my collections, I can easily get another 50,000. Then increase the dividend. Then I'm gonna buy it. But the other option is don't increase the dividend, keep the same dividend, improve your accounts receivables, and check the short-term investment. Is there anything that you can close right now without losing money? That will be the other option. Whatever you decide, it doesn't matter what you're going to decide. As long as you can recommend, you're fine. So in order to get the full marks, you have to have discussion on all those 6 things. I'm going to look for 6 things here. Current situation, just briefly about increases, the cost, and what do you think is the company. Liquidity, definitely discussion, liquidity, current ratio, that should be discussion. Quick ratio discussion. Profitability versus revenue, another discussion. Outline the two options. Now you can literally get it from the case and put it on the paper. You don't have to worry too much here. Just outline the two and recommend one option. Recommendation has to be explicit and clear and direct. Means tell me exactly. My recommendation is do this, since you're going to be doing it as an individual. Once you have those 6 things, you're going to get your full marks for the content. That's what I expect as a content on this part of the memo. Make sense?
Yes, Professor.
Okay.
Yes, Professor.
What we'll be doing on the current situation? Like we'll be discussing
On the
or
current
we'll
situation, just explain basically. Currently in the company, the expenses goes up based on the information provided. The company the expenses goes up. There's increase, decrease. The cash. Start with the balance sheet. Start with this information. Currently, the company, the cash is reducing. short-term investment increasing, accounts receivables reducing. On the accounts receivables, once you see the reduction in accounts receivables, now if you want, this is the option for you now. Since you have the accounts receivables and you have the revenue, you can come up with the ratio on the accounts receivables. Can you?
Okay, yes,
On the
Professor.
activity ratio. But I'm not gonna chase you for that. Do you understand this? I'm not gonna chase you. If you decide to go further, because here we don't have the credit sales. The only thing that you can comment here is on the accounts receivables goes up. So basically, you can provide some recommendation on accounts receivable. Maybe you should straighten the accounts receivables and this and this and this and this. But the current situation, just give the overall situation of the company, right? Before you start chasing the ratios.
Okay.
Tell them, tell again that the profit, so you can see here the net income goes down. Because this is between the accountant, right? The accountant tells you that. Accountant tells you that the income goes down.
Okay.
Revenue goes up, but the income goes down. First, discuss the balance sheet information that you have in the current assets. Then discuss a little bit on the revenue and expenses. And that will be it. It doesn't have to be too much. If it's going to be one paragraph, here you can put it one paragraph. A will be for the balance sheet information. That will be the current assets and liabilities. One thing. And the second one will be the income statement. Information, that will be the revenue, expenses, net income. And that's it. One paragraph here, one paragraph here. Doesn't have to be one paragraph for the current ratio, one paragraph to the quick ratio, profitability, net income versus revenue, again, discussion. Here on the profitability. Now here you're chasing the profit only. Net income versus revenue, that's a ratio here. Outline the two options, recommend one of the options, done. You have to have 1, 2, 3, 4, 5, 6, 7 paragraphs. If you go a step further, obviously there will be bonus points for you.
Okay, this balance sheet information and
Yeah,
is enough.
income
Is
statement,
enough,
yeah.
and income statement is enough for the current statement.
Yeah, the current situation, yes. More
The
than
current
enough.
situation,
Yeah.
more than
What else you can discuss? There's not much here to discuss. You don't have that much information.
okay. We can do it in other ones too.
Right. So the other thing here is, let's see section B. How big the section B? Not that big. Let's see if we can quick cover this. Or shall we leave the section B for the next time?
Let's do it. Let's do it.
Let's do it.
Yes, Professor. Let's just.
Okay. After 1 week, has made a strategic decision to invest on the heating, ventilation, air conditioning system. The system feature dual zone climate control, advanced blah 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 blah. The investment is anticipated. So why we're doing this? To reduce the energy cost and the value of the property. The hotel has incurred the various costs associated with the purchase and implementation of the HVAC system. The cost including the purchase price. So what you have to find out here is, from this information, is how much is the total cost. What was the rule? Once the system is ready to use, then we can say that's a final cost. So the cost include purchase price, installation, staff training, specialized maintenance tools, delivery cost, electrical system upgrade. Now, For 100, promotional material 1,000, extended warranty for 4,000, government compliance fee 500. HVAC system as expected to have a useful life 15 years and residual value 10,000 at the end of useful life. So, what's the cost? Obviously, purchase price plus installation, plus the staff training, plus the special maintenance tool, plus delivery cost. How about the upgrade of the electrical system?
It's not a cost.
Sorry,
It's not included.
that's not
Wait.
included. How about promotional material?
No.
No. How about the extended warranty for 4,000?
No.
No. Government compliance?
Yes.
It's included.
Yes, that's
Yes.
included. Okay. So we have the cost. We have the cost. You have the residual value. You have 15 years. Right? We have the information about this. So now let's see what's the extract from the meeting. Trainee. Due to light of our current liquidity changes, the total investment is 160,500 for the new WAC system. We need to consider our management option carefully, especially given the recent drop of the profit. Good. Are we sure about the estimate? So you have to be sure. Change the estimate and see if that's how much you're going to come up with. If not, change the estimate. To clarify the financing, one of the existing 20% owner has expressed interest either purchasing an additional 10% of the ownership for 200,000 or lending us money of 8% interest. We need to explore the pros and cons of accepting additional equity versus taking debt. Additionally, how should we reflect this on the financial statements and what will be the most suitable depreciation method to apply? Jude, when considering depreciation method HVAC system, one of the options might be this pattern of the benefits we're expecting from the upgrade. Which method are you hinting at and what does align with the benefits? I'm referring to acceptable method. It's quite interesting how the spread the expenses differently over the time. If we think about when we expect the system to have the greatest impact on our operation and the guest experience, that could be the correlation here. Are you suggesting that the method are thinking could match our initial revenue expectation with the system performance? You are on the right track. It could worth exploring how this method reflects the system unity and earlier versus later on, especially consider the nature of our system. A new system is expected to influence our guests in operation. I'm not entirely convinced would a higher expense upfront affect the net income when we might be ready to facing the profitability charges. That's a valid concern. However, consider the impact of the new efficient system in our current financial situation, how might want to represent to our books. It's about finding the balance between immediate financial portrait and the long-term benefits. So it sounds like you're suggesting that a strategic angle of method possibly related to future financial planning, current operation benefits. Precisely. How about examine the number under this method and consider impact of the entire system? It might be a way accounting depreciation. All right, let's model the number, but make sure that we already discuss and justify this approach with our to our stakeholders. They need to understand why we might favor this method over the more conventional one. In the wake of the HVAC system upgrade, we're exploring a variety of strategies to capitalize benefits. Our marketing initiative should be accurately reflecting the enhancement of the system bring. What narrative should we craft to evaluate market presence in entire broad reflected our messaging that align with the commitment to wellness. Additionally, consider the implication of the advertisement may have on our team composition. We just Fourth term of staffing needs. Think about the
Specialized skills.
specialized conditional support might become necessary to immediate alternative installation. How needs may change. Moreover, could this technology advancement streamline our operation and degree the influence on long-term staffing? So basically, this one is like a general discussion of the impact of this new system. So where the system gonna hit you? First, it's a new system, so we have to train our staff, right? Training our staff is going to drive more cost. One thing, but on the long term, we're going to be fine. Now, once we train our staff, now we probably have to give them some increase, so we keep them in the company because we don't want to turn over here. Make sense?
Yes.
So we have to keep them and make sure that they stay on the long term, preferably at least 10 years. See, if the useful life of the VAC system is 15 years, we want those employees to stay at least 10 years to cover most of the useful life of the machine. So in the future, enhance hotel reputation. So basically, once we do that, we have to make sure that we advertise this to our clients, that we have a new system which is cost efficient and blah, 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 in order to increase our sales, right? To future enhance the hotel reputation, you decide to implement the innovative feedback system. Guests were encouraged to leave the detailed review about their stay, view with the promise of a discount for the next visit. The system was a hit, with a number of guests providing growing testimonial. However, Jude soon realized that the many reviews exaggerated the quality of their stay, influenced the discount incentive. Despite the boost of the business, some staff members felt uneasy about the practice, questioning the integrity of their review and honesty of the whole hotel image. The situation became more complicated when the renewed travel blogger planning to future was offered this discount exchange for positive review. So just seeking your consultant experience to provide a concise business memo about, so what you have to do, we have to do the memo about boutique wellness hotel. The task involve advertising financial reports, system costs, capitalization, depreciation strategy, liquidity management, ethic, and their impact on the profitability. We expect a data-driven recommendation to address all the critical financial operation concern with a timely manner, which you guidance in the is instrumental, helpful to make informative decision and enhance the future performance. So what we can take from here, from the part B? From the part B, what we chasing? We're chasing the system. Come up with the proper cost of the system. Once you have the residual value, once you have the useful life, what I want you to think is which depreciation method we should use. And if we use the straight line method, what will be the effect on the financial? If you decide to use some declining method, what will be the effect as well? Make sense?
Yes, Professor.
Those are the only two methods that you can use. Either straight line method, either the declining method. Why? Because you don't have anything for the usage, right?
Yes,
Any other information. So only this information. So quickly, just to show you how one affect the other one, let's go to chapter, I believe, chapter 4 on the long-term assets and show you here on the screen. Let's share again, and that will be this one. So what's the difference between one and another? Let me quickly find it. Watch this. This is the difference. And this how we're gonna hit you on the financial statement. On the straight line method, it's gonna be steady year after year after year after year. So the expense will be exactly the same. With the declining, in the first year, you're gonna have a huge expense, and later year, you're gonna have less expense as a depreciation. How this gonna hit you on the financial statements? Obviously, in the straight line method, you're gonna have the steady expense through the year, 15 years of usage, where in the declining, in the first year, you're gonna have huge reduction of the profit, and later on, later years, you're gonna have increase in profit. Make sense?
Yes, Professor.
So you have to discuss those one in order to choose which method to use. Use here the information and decide to one of the method. Either one is fine. Either one is fine. Now, that's one
Either
thing.
straight line method or double decline method.
Right, sorry?
Either straight line method or double decline method.
Double declining is fine, as long as you can justify it. So first, what you have to discuss here, the cost of the asset. Second, depreciation method. You can do some calculation. You have the information for the calculation. Straight line versus double declining. Make sense? Once you're done with this, since you have the cost of the asset and since you have the method, you can think about the financial options here. Right? One option is to additional ownership, 10% of the ownership. So financial options, and that will be will be shares or equity, and the other one is
Interest.
credit or borrowing, which involve liability with interest. So just briefly discuss what's the difference between one shares and liability. Make sense? How, if we issue more shares, how this going to affect the existing shareholders? If we borrow money, what the effect will be? Right? Those are the two things that you need to discuss just briefly, nothing in deep here. And once we're done with this, then come up here with some idea about how we're gonna implement that HVAC system. So that will be the effect on the system. So that will be for effect on the system. Here you can have effect on training of employee. What else? Retaining employee. And what will be the advertising? And that's that should be more than enough. Effect on the system, on the hotel, right? Once we're done with this, where are we going from here? Reputation. Now, from the reputation, I want you to draw this ethical problem. And how realistic are the reviews? And can we actually rely on the review? Is it okay? So you can see here, is it okay we to offer high discount for the positive review? That's where we are here. Make sense? That's your problem. That's your ethical problem here. Offer discount in exchange for positive review. And once you're done with this, make a recommendation here. And you're done. Make sense?
Yes, Professor.
So we have two parts, right? We have two parts, but basically you have to write one memo. Let's set up the rules now. Here you have 1, 2, 3, 4, 5, 6, 7 things, 7 items to write about. Here you're gonna have 1, 2, 3, 4, 5, 6, 7, 8, 9 items to write off. 9 items. So 7 and 9, that's total 16 items, right? 16 items or 16 paragraphs. As long as you have between, let's say, how many? How many will be the bottom? How many will be acceptable? Between 13 and 16, if you write between 13 and 16 items out of everything, you're gonna get full marks for content.
Please off the mic.
If you get, let's say, 10 to 13, from 10 to 13, you're gonna get, now depends on the how
Excuse me.
many, you're gonna get less marks and less and less. Make sense? So in order to get your full marks, you need to have between 13 and 16 item of those one that we identify. Start working on your assignment, and we can discuss more next time. Okay?
Okay, Professor.
I'm gonna
Um,
post you this recording. So you're gonna have the recordings from the lecture and the recordings from this.